How severe would you take the bond market warning if you're a stock market investor?
We look at the yield curve. We don't ignore it. What it's telling us is that this is a later cycle economy. Next month in June, this will tie the longest expansion on record, but we don't treat it as a crystal ball. And we're very sympathetic to this argument that there are a lot of demand forces serving as very heavy anchors on the yield curve that distort the signal it could be sending at a normal cycle. So things like the Fed balance sheet, the process of wind down ending in October, the Fed becoming a net buyer once again of treasuries, as well as a lot of foreign demand, something we saw on Tuesday after the European parliamentary elections.
So it doesn't spook you away from stocks?
So it doesn't spook us necessarily in and of itself. We are concerned by the risk of trade tensions, but that is a slightly separate issue than the discussion around the yield curve.
Mark, what about you?
Well, I think it's a great point to look at something like what's going on around the world. And it's certainly true that global PMIs have come down, and that has sparked demand for things like treasuries. Yes, we're later cycle, but we think the cycle is a little bit on hold because the Fed has indicated that it's on hold. And so when you look at the U.S. economy in totality, you've got some great hard data around things like unemployment and growing productivity, and it's the softer data that is around sentiment, which is coming in weaker now.
And if you look at the action in the market, Gabriela, utilities are the only group that's higher, which you might expect when bond yields go down. Yesterday was a funky day because you got those low yields and the consumer staples and utilities got hit the hardest. What do you do with the defensive sectors? Are they where you want to be right now, or they get into overvalued?
Well, Sarah, so our characterization of the economy right now, later cycle, as we mentioned, a signal we're getting from the yield curve. We are seeing a slowdown from last year's sprint pace, totally expected, back to a 2% average growth rate. We would still characterize recession odds as low. So it's not an easy call to be full in on defensives, ignoring the cyclicals altogether. So what we would do is a better balance between the growth tech side and the value side, which will include some of the defensive stocks, but not exclusively. It'll also include some other stocks that are more income friendly, but also cyclical, things like financials and energy. So a better balance between the two, acknowledging late cycle risks as well as the potential downside from the trade war.
When do you start arguing that the Fed's too tight if we're in a trade war?
So I think it would very much depend what the next step is. If all we do is just remain in this uncertain scenario, this heavy cloud hanging behind us, that's okay. If we take that next step, that next escalation of 25% tariffs on $300 billion, that is a much more serious scenario for the economy. And then we do expect the Fed to cut, focusing on the negative economic impact.
And your base case is that we don't do that fourth list?
The base case right now is yes, but we do acknowledge the risk has gone up over the past, well, since the 5th of May, shall we say.
So go ahead.
No, go ahead.
I was just looking at a list of 52-week lows. We just got emailed to us, Mark. A lot of retailers on that list. Tapestry, Macy's, Kohl's, Nordstrom, Gap, Foot Locker, Capri Holdings. I mean, is the consumer fine or not?
Well, given the employment situation, I think the consumer is doing well. Now, that said, that's not our favorite sector globally or in the United States. I like this idea of looking at the sides of tech that are less likely to get caught up in the trade war, more on some of the communications and internet side, and then also looking at value, things like energy, because we do think that there is still global demand for oil and that they can improve as we get further into the year.
Where would you be around the world, Mark? I know you've got more of a sort of global view when it comes to asset allocation. Are you better off outside the U.S. or in it?
We think so. We're neutral on U.S. equities. I can tell you I've been traveling around the world, both the United States and China. And one thing I think it's important for your viewers to understand is that, opinion leaders in the United States will say China has more to lose. But when you're traveling in Asia, they believe the United States has more to lose. Both sides have levers here to pull, and we don't think they're done pulling them. So we don't think that either side is rushing to a deal right now. And so I think on the equities, we would look more towards doing some relative value trades, something like being overweight Canadian stocks and underweight the Swiss stocks, for example.
Gabriela, everyone and no one is really an expert in this trade dispute. I mean, it's very difficult to really truly understand what is going to happen. But if I make an assumption that we are going to go to 25 on the 300 billion, what should I be doing as an investor?
So we think in that case, a further escalation, that would be a negative for the Chinese economy, would require more stimulus on their side, but would also be a negative for the U.S. economy.
So do I pull back my allocation to equities?
So
what do I do?
What we're thinking about is being more neutral, the stock bond side, right? And within equities, what we're thinking more about is that better balance between growth and value, and also strategies that can allow us to hedge a little bit on the downside with options. So you can participate if that doesn't happen, right? You can participate on the market rally, but you are hedged on the downside in case that worst outcome does happen.
A lot of that may already be taking place right now.
I think some of it is, right? So the market is very healthily adjusting for that uncertain outlook on trade, what it means for the economy and earnings. That's healthy to see. But if we had that 25% escalation, then you would see more downside in the market.
Mark, Reuters has a good piece out today about the street's median year-end target. 29.25 is actually higher than it was in February before this trade war really erupted. Your expectations, for separate from your own call, but when do you think the street gets religion, if at all, on year-end targets or earnings?
Look, I think that it's one of these issues where we talked. You were talking earlier on the show about is there a Trump put and a Fed put, and keep in mind the president can take these tariffs off, at some point when it starts to really hurt the U.S. economy. And I think that that's why, given the strength of the hard data, many of the economists and forecasters out there are not willing to give up on higher markets this year. So there is there's certainly some truth to that you just can't give up, because both sides still have reasons to strike a deal at this point. And so while we don't think that you're going to get one at the G20, maybe later in the year they find a basis for an accord.
I mean, my other question, sector-wise, is what do you do with technology stocks, which have gotten caught up in the crosshairs between Huawei, now China's threatening to pull rare earth metals. I mean, have you guys done work on who might be exposed and what you do with that overall sector?
So for technology, we don't want to completely abandon it, right? Because it is a very strong structural story there around software and cloud computing and AI. So we can't give up on it. But I think the tendency over the past few years, because it was such a strong performer, was to be all in on tech and growth. And all that we're advising is to maybe take some chips off that table and start to have a better balance between technology as well as other sectors. So I think it's a story more of being a little bit more cautious, a little bit more balanced, but not abandoning the story altogether.